In 1952, a young PhD student sat in the library at the University of Chicago, pondering a question that would revolutionize the world of investing. Could the chaotic world of stocks and bonds be tamed by mathematics? His name was Harry Markowitz, and his answer would transform investing from an art of intuition into a science of precision. Before Markowitz, Wall Street was a different world. Picture a 1940s trading floor. Traders relied on gut feelings, whispered tips, and rules of thumb passed down through generations. Buy what you know, they'd say. Never put all your eggs in one basket. Sound advice, perhaps, but hardly scientific. Investment decisions worth millions were made based on little more than hunches and handshakes. But something was brewing beneath the surface of finance. The post-war boom had brought more everyday Americans into the market than ever before. The old ways of investing, based on intuition and experience, were no longer enough. The market needed a revolution. That revolution would come from an unlikely source: modern mathematics. In the span of just 12 years, from 1952 to 1964, 3 breakthrough moments would completely reshape how we think about risk, return, and the fundamental nature of investment itself. Think of it like this. If investing before 1952 was like medieval medicine, with its mix of folk wisdom and educated guesses, what came after was more like modern medicine, with its rigorous testing, precise measurements, and mathematical models. Today, every time you check your 401k, use a robo-advisor, or make an investment decision based on risk metrics, you're standing on the shoulders of a revolution that began with a graduate student's simple question: what if we could measure investment risk with the same precision that physicists measure the motion of planets? Let's journey through the 3 moments that transformed investing from an art into a science, and discover how a handful of brilliant minds created tools that would change finance forever. Harry Markowitz made a discovery that would seem obvious today, but was revolutionary in 1952. The riskiness of a portfolio depends not just on individual stocks, but on how they move together. This insight might sound simple, but it transformed our understanding of investment risk forever. Picture 2 companies. The first sells ice cream, the second sells umbrellas. Both are risky investments on their own. When it rains, umbrella sales soar while ice cream sales plummet. When the sun shines, the opposite occurs. Markowitz realized something profound. By combining these opposing movements, you could create something more stable than either investment alone. But Markowitz went further. He didn't just suggest this idea, he proved it mathematically. Using complex statistical tools, he demonstrated that you could calculate exactly how much combining different investments would reduce your risk. His work showed that by carefully selecting investments that don't move in perfect sync, you could build portfolios that offered better returns for the same level of risk. The mathematics behind this were revolutionary. Markowitz introduced specific formulas for calculating portfolio risk using variances and covariances. For instance, he showed that a portfolio split equally between 2 stocks with a correlation of -0.5 would have significantly less risk than either stock alone. Consider a real example from Markowitz's early research. He found that a portfolio divided between bonds and stocks could achieve nearly the same return as an all-stock portfolio, but with substantially less risk. According to his calculations, a 60-40 split between stocks and bonds reduced portfolio variance by about 25% compared to a stocks-only approach, while sacrificing only a small portion of the expected return. Markowitz's work created what we now call the efficient frontier, a mathematical curve showing the optimal portfolios that offer the highest expected return for any given level of risk. This wasn't just an academic exercise. For the first time, investors could scientifically analyze the trade-off between risk and return. But despite this breakthrough, something crucial was still missing. While Markowitz had shown how to build better portfolios, he hadn't answered a fundamental question. How do you determine the right price for a risky asset in the first place? This puzzle would require another breakthrough, one that would come from a brilliant young graduate student named William Sharpe. What Markowitz had done was create the foundation. He showed us how to measure and manage risk in a portfolio. But to complete the revolution in financial thinking, someone needed to connect this understanding of risk to the actual prices of stocks in the market. That connection would come in 1964, and it would change everything once again. In 1964, William Sharpe made a discovery that would earn him a Nobel Prize and revolutionize how we think about investment risk. His insight: not all investment risk is created equal. Some risks can be eliminated through diversification, while others are inherent to the market itself. Sharpe's breakthrough came from a simple but powerful observation. When he analyzed stock returns, he noticed that some stocks consistently moved more dramatically than the overall market, while others were more stable. This led him to develop the concept of beta, a measure of how sensitive an investment is to market movements. Consider two real examples from the early days of CAPM. Technology companies like IBM typically had betas around 1.5, meaning they moved 50% more than the market in either direction. Utility companies, by contrast, had betas around 0.5, meaning they moved only half as much as the market. Sharpe's model made a bold prediction. The only risk investors should be paid for taking is systematic risk, the kind you can't diversify away. According to research published in the Journal of Finance, this insight helped explain why some high-risk stocks didn't necessarily offer higher returns. Sharpe introduced the concept of the market portfolio, a theoretical portfolio containing every risky asset in the economy, weighted by its market value. This idea, combined with beta, led to a simple but powerful formula for determining expected returns. Expected return equals risk-free rate plus beta x, expected market return, risk-free rate. Take Microsoft in the 1990s, for example. With a beta of 1.2, if the market risk premium, market return minus risk-free rate, was 6% and the risk-free rate was 3%, CAPM predicted Microsoft should offer an expected return of 10.2%. 3% plus 1.2 implies 6%. The beauty of CAPM lies in its simplicity. By reducing the complexity of investment risk to a single number, beta, it provided investors with a practical tool for making investment decisions. But this simplicity came at a cost. Critics pointed out that the real world was messier than CAPM's elegant mathematics suggested. According to studies by Eugene Fama and Kenneth French in the early 1990s, stocks with low betas often earned higher returns than CAPM predicted, while high beta stocks earned less. These findings would eventually lead to more sophisticated models. Today, every major financial institution uses some version of CAPM in their investment analysis. Whether you're a pension fund manager deciding on asset allocation or an individual investor checking your portfolio's risk level, you're building on Sharpe's groundbreaking insights about the relationship between risk and return. But even as CAPM transformed investment practice, questions remained. How well does the model work in different market conditions? What happens when its assumptions don't hold? And most importantly, how could we test whether its predictions actually matched reality? These questions would lead to the next major breakthrough in financial economics, one that would put theory to the test in ways no one had attempted before. The 1970s brought CAPM's elegant mathematics face to face with messy reality. This was the decade when theory met practice, and the results were both enlightening and humbling. Consider this striking discovery from the early empirical tests. When researchers compared portfolios with the lowest beta, around 0.2, to those with the highest beta, around 1.6, they found something unexpected. The low beta portfolio actually returned 11.1% annually, significantly higher than CAPM's prediction of 8.3%. Meanwhile, the high beta portfolio returned just 13.7%, well below its predicted 16.8%. This wasn't just an academic curiosity. Mutual fund managers who had embraced CAPM found themselves grappling with its limitations. The model suggested that aggressive, high beta portfolios should dramatically outperform conservative ones during bull markets. But reality proved more nuanced. The concept of the risk-free rate, a cornerstone of CAPM, also faced scrutiny. Treasury bills, considered the closest approximation to a risk-free investment, saw their yields fluctuate significantly during the 1970s. According to historical data, 3-month Treasury bill rates swung from 4% to over 11% during this period, challenging CAPM's assumption of a stable, risk-free rate. But CAPM wasn't without its victories. The model proved remarkably useful for understanding systematic risk. When researchers examined market data from 1926 to 1968, they found that about 70% of a typical stock's risk could be explained by its relationship to the overall market. Exactly what CAPM predicted. Perhaps most importantly, the 1970s revealed something profound about market efficiency. If CAPM was perfectly accurate, it would be impossible to consistently beat the market by picking individual stocks. The fact that some investors seemed to do just that suggested either that markets weren't as efficient as theorists believed, or that risk had more dimensions than CAPM recognized. Take the case of value stocks, companies trading at low prices relative to their fundamentals. According to CAPM, these stocks' excess returns should be entirely explained by their beta. But studies during the 1970s showed that value stocks consistently outperformed growth stocks, even after accounting for beta. The decade also saw the rise of institutional investing, with pension funds and mutual funds becoming major market players. These institutions needed practical tools for portfolio management, and despite its limitations, CAPM provided a framework that was both theoretically sound and practically applicable. According to industry data from the period, by 1979, over 70% of institutional investors were using some form of CAPM in their investment process. Yet perhaps the most lasting legacy of the 1970s was how it changed our understanding of what financial models can and cannot do. CAPM wasn't perfect, but it was useful. It provided a structured way to think about risk and return, even if reality sometimes departed from its predictions. This tension between theory and practice led to important innovations. Researchers began developing more sophisticated models that could account for the anomalies CAPM couldn't explain. But even as new models emerged, CAPM's core insight, that systematic risk matters more than individual stock risk, remained fundamentally sound. The real-world test of the 1970s showed us that while mathematics can illuminate financial markets, it can't perfectly predict them. Markets are human institutions, subject to forces that no single model can fully capture. This understanding would prove crucial as finance continued to evolve, leading to new theories and tools that built upon, rather than replaced, CAPM's foundation. Walk into any major investment firm today, and you'll find CAPM's fingerprints everywhere. From sophisticated trading algorithms to retirement planning tools, the model's influence persists despite well-documented limitations. It's like a simplified map that, while not perfect, still helps us navigate the complex terrain of modern finance. Consider how BlackRock, the world's largest asset manager, incorporates CAPM principles into their risk management systems. Their Aladdin platform, which manages over $21 trillion in assets, uses beta calculations and systematic risk assessment derived directly from CAPM's framework. The data tells an interesting story about CAPM's predictive power. Recent studies show that while the model correctly predicted market movements in 10 out of 11 years, from 2010 to 2020, its accuracy varies significantly across different sectors. Technology stocks, for instance, have shown higher betas than CAPM would suggest, while utility companies have demonstrated more market sensitivity than their traditionally low betas would indicate. Modern portfolio management software has evolved to address CAPM's limitations while preserving its core insights. These systems now integrate multiple risk factors beyond beta, including size, value, and momentum. Yet the fundamental concept of systematic versus unsystematic risk remains central to how they analyze investment opportunities. Take the rise of ESG, environmental, social, and governance investing. While CAPM wasn't designed to account for these modern concerns, investment firms have adapted the model to incorporate ESG risks into their beta calculations. The famous French three-factor model, developed in the 1990s, expanded on CAPM by adding size and value factors to beta. According to their research, this enhanced model explains up to 90% of portfolio returns compared to CAPM's 70%. Perhaps most telling is how CAPM has influenced modern index investing. When Jack Bogle created the first index fund in 1975, he built it on CAPM's insight that market risk is the primary driver of returns. Today, index funds manage over $11 trillion globally, a testament to the enduring power of this idea. But CAPM's modern legacy isn't just about its successes. It's also about its limitations. High-frequency trading, complex derivatives, and global market integration have created challenges that the original model never contemplated. New research suggests that beta itself may be unstable over time, particularly during market crises. Consider the 2008 financial crisis. Traditional CAPM beta calculations failed to capture the systematic risk that emerged when seemingly unrelated assets suddenly moved in lockstep. This led to the development of more sophisticated risk measures. Yet beta remains a crucial starting point for risk assessment. The model's enduring influence also extends to how we educate future finance professionals. Every MBA student still learns CAPM, not because it's perfect, but because it provides a fundamental framework for understanding the relationship between risk and return. It's like learning Newton's laws before studying quantum mechanics, a necessary foundation for more complex theories. Looking ahead, CAPM continues to evolve. Machine learning algorithms now incorporate CAPM principles while accounting for nonlinear relationships and dynamic market conditions. Blockchain technology and decentralized finance are creating new challenges for risk assessment, yet the core insight about systematic risk remains relevant. The story of CAPM is ultimately about how a simple but powerful idea can shape an entire field. While we now recognize its limitations, its fundamental insights about risk and return continue to influence how trillions of dollars are invested. In an increasingly complex financial world, CAPM's elegant simplicity remains both its greatest strength and its most notable weakness. Over the past 60 years, CAPM has evolved from a revolutionary theory to a fundamental tool in modern finance. But perhaps its greatest value lies not in its mathematical precision, but in how it changes the way we think about risk and return. How would you explain why diversification reduces risk without reducing expected returns? Think about Markowitz's ice cream and umbrella example. What underlying principle makes this seemingly magical result possible? If you discovered a stock with a negative beta, what would this mean for your portfolio? Consider how such an investment might perform during market downturns, and why this characteristic might be particularly valuable in certain economic conditions. Why might CAPM underestimate the expected returns of small-cap stocks? Think about the additional risks that smaller companies face, which might not be captured by beta alone. How would you use CAPM to decide if a stock is overvalued? Consider what the model tells us about the relationship between risk and required return, and how this might help identify mispriced securities. These questions point to deeper truths about markets, risk, and human behavior, truths that continue to challenge and inspire financial thinkers today.